Hello and welcome to Commodity Champions. I'm Manisha Gupta, and the oil markets continue to see volatility as macro factors push prices either ways, seemingly by the hour. The revival of the 2015 nuclear deal has been subduing prices, as a revival in the deal will lead to a rise in supply. However, warnings of an output cut by OPEC and allies nations to control the fall sent prices higher. Despite this, a cut in Chinese demand weighs on a long-term outlook for prices. The world's #1 oil importer continues to be plagued with a heat wave, forest fires and political tensions with Taiwan, which ensures to keep demand lower. So what lies ahead for the oil market amidst all this turmoil? Joining me to take that discussion forward is Hansen, the head of commodity strategy at Rabobank. Hi, always a pleasure having you. And what a volatile week this continues to be, where we are looking at the crude oil prices trying to swing on both sides of $90 per barrel. But first up, how are you reading these statements from the OPEC Secretary General and then the Saudi Arabian minister about cutting supplies going forward?
Well, good afternoon. I think what we saw yesterday in that comment from Saudi Arabia is really what we have been seeing in the market as well for a while. That there is a certain disconnect between the futures market, so-called paper market, and the underlying physical market. Just take a look recently at the renewed rally in diesel margins, simply because demand for refined products are strong because gas prices are as elevated as they are around the world. So we have a futures market where macro-orientated traders are selling oil as a hedge against an economic slowdown, but at the same time it just doesn't add up with the underlying developments that we're seeing in the market. So I believe that we're pretty close to a low point here in the oil markets, and I can also I see the reason why the Saudi comment came yesterday, and it is just highlighting also a market maybe a little bit troubled by low liquidity and a lot of participants not as active as they have been.
All with the kind of profit taking that we have seen in most part of August, where 90 seems to be the new 100 now. What is your sense on where are we headed in sense of price? I mean, are you working with a range right now?
Well, as long as the recessionary threat remains as real as it potentially could be, especially in places like Europe, then that will have a negative impact on price action. But if the underlying fundamentals continue to point to reasonable strength in demand, or at least not a slowdown in demand, then eventually prices will reassert themselves, and then we're left with a speculative interest, which is the lowest in more than 2 years, lowest since April 2020. And that could potentially trigger a rebound. So for our quarterly outlook that was out obviously a little while back, we were looking for a 95 to 115 range. We hold on to that, but at this moment it looks like it's more 95 to 105 range. But I think we are at or near the low point in oil here.
All right. That being said, how are you looking at the gas prices? Because that has been another animal in itself. And I mean, a 15 to 20% of a move on a daily basis is something that you've learned to live with right now. But with what's happening between Russia and Europe, what is your sense? How much higher are we headed from here?
Well, it really all depends on the supply security heading into the autumn months. We're only a month away now from the winter demand season starting in Europe, and markets have been caught out by the worries about the renewed maintenance on the Nord Stream 1 gas line, which is going to be out of action for 3 days. The market clearly worries that the supplies will not come back next week when that maintenance is over. And at the same time, very low water levels on the River Rhine this summer, which has reduced the ability to move gasoline, diesel and coal to utilities. So that's all putting upward prices. I think what we're seeing right now is a level that is so high that industries have stopped forward hedging their gas needs, simply because this price is not economically viable. So unfortunately, we're looking into an autumn where we'll either see demand destruction through industries turning down their demand, or the potential or the hopeful solution that we're going to see lower prices at some point.
I mean, as you mentioned, there are drought concerns, situations in China and in many parts of Europe as well. Power rationing seems to be like the common buzzword right now. And then the gas availability is the third point here. So at almost nudging $10 per MMBTU for the US gas prices, how much higher do we still have?
Well, in the US, US price is obviously $10, as you mentioned. If we look at the equivalent price in Europe, we are looking at $80. So we are trading 8 times higher in Europe right now. $10 gas in the US potentially could be even more over the coming months. Inventory levels are relatively low compared to where they would like to see them. We still have Freeport LNG export plant about to resume exports within the next month or so. That would also reduce the availability of gas in the US. So we're just simply looking into a winter where energy prices will be high. It will be challenging the central bank's ability to bring down inflation to levels that at least the market right now is pricing in. And that's also one of the reasons why we still favor the commodity as a sector, as a hedge, and also looking at something like the gold prices, which have come down quite a bit as well recently.
Oh, well, yes. I will talk to you about gold, but I still have one question on gas. And this is, we still have a hurricane season pending. And from 5th of December, European Union has put out a sanction on Russia that they would put in. And then everybody's talking about a harsh winter going forward. They are still recovering from heat waves, as we've seen in Europe, and higher than normal temperatures in US and etc. So as we head towards the last part of this year, what can be expected from gas prices?
High prices, unfortunately. Hopefully not as high as they are right now, because we have to remember that we've seen almost a doubling the price over the past month. And some of the reason why we saw that doubling, they may start to ease somewhat, but still punitively high prices, forcing some kind of demand destruction, and with that obviously lower growth, and with that also the weakness that we're currently seeing in the euro against the dollar.
You mentioned about gold, and I'll come to that. And the gold prices have been a bit of a disappointment. I mean, we've seen nearly 5% negative right now in the dollar terms for the year until now. On one side, yes, there are recession fears and there is a war raging, but on the other side, you have the strong dollar index and the rate hikes as well. So would you say that all the factors really seem to be negating themselves, and that is putting pressure?
Well, it's a little bit controversial, I think, sometimes to say, but I think actually gold has done brilliantly. I think it's done what it's supposed to be doing this year. Yes, in dollar terms, it's down, but almost in any other currency, it's up on the year. And just look at gold as a part of a portfolio in order to mitigate risks elsewhere. We got the bond ETFs sharply lower. We got the stock market sharply lower this year. So if you as an investor bought into gold at the beginning of the year, even if you're dollar-based, I'm sure you're very happy with a 5% loss compared to 15, 20, 25% loss in the bond and the stock market. And also we have to consider that we have gone through the biggest jump in real yields since 2013 this year, and we've seen probably one of the biggest annual increase in the dollar also in a number of years. So against all these very, very strong headwinds, gold is only down smaller in a year, and it's up quite a bit across in other currencies. So I still like gold. I still like I don't like the inflation, but I worry that inflation is not going to come down at the speed that the market is pricing it. And when that starts to be realized in the market, that will add a new dimension to gold. Also on top of that, adding the demand, physical demand from China and India, which has actually been reasonably strong in the past couple of months after the price came down.
Ol, how are you looking at the metal prices? Because even as China has been cutting interest rates while all other countries are increasing interest rates, but the quantum really is too small for the markets to start moving.
Metals are in a holding position here, but what we also have to remember there is that it's not only about demand when it comes to commodities. Supply is equally important. It is a market that needs to balance on a daily basis. And with the gas prices, again, returning to those levels, we've seen this, as you mentioned as well, smelters reducing capacity in Europe. That obviously reducing the supply side, and that's alleviating some of the potential worries about demand, at least here in the short term. We got a congress in China later this autumn, and I'm a firm believer that they will have to do something to mitigate some of the economic risks they're seeing right now, especially within the commodity sector, in order just to maintain social stability, which is the key essence for the government. So with that in mind, metals are not going to have a great upward scenario, at least in the short term. But from a longer term perspective, I like metals. I like industrial metals. I like the miners. I think looking into the future, the demand will only continue to remain robust, and supply will potentially be increasingly challenged.
All right, so short term, not so great for the metal prices, but a longer term, yes, the demand will come back. So will the energy transition and all those things that the world has been talking about. But just for the near term, there are way more concerns. Well, as always, thank you so much for joining us and making sense of that volatility that we have seen in many of those commodities. On that note, we will head for a short break. But coming up, a discussion with Michael DiRienzo, Executive Director at the Silver Institute, on the rise in demand for silver. Stay tuned on the other side. Welcome back to Commodity Champions. The demand for silver in 2021 was the highest since 2015, and this is set to rise further this year according to the World Silver Survey 2022 by the Silver Institute itself. The total supply of silver globally is expected to increase by 3%, aided by mine production and a rise in industrial recycling. The report also sees global demand for silver rising by 5% for 2022 due to a recovery in jewelry and silverware. To speak more about the findings of the report and the silver outlook for the rest of this year, I am now joined by Michael DiRienzo. He's Executive Director at the Silver Institute. Michael, hi. Thank you so much for joining us. First of all, what is the kind of demand that we're expecting this year? I mean, the last year was really good. At various levels, we saw demand perk up as compared to the previous year. How is this year until now looking to you?
Well, hi, Manisha. It's always good to be with you. We think that even though we have some recession fears, that demand has been quite resilient so far in 2022. On the industrial side, which of course is what everybody looks to, the total is expected to grow by about 6% to achieve an all-time high this year. We think that the industrial applications are benefiting strongly from electrification, including higher electrical vehicles, higher silver-bearing electronics, and devices per car. And also, you can't forget about the fact that these charging stations, which are being installed all throughout the world for these vehicles, is a win-win for silver. And we can't forget about PV, photovoltaics is too. The strong demand from those areas is quite exceptional. Jewelry and silverware, we expect a double-digit growth this year. That'll be led by India. And on terms of investment demand, we think it'll be strong. We don't think it'll be as strong as it was in 2021, but inflationary concerns and geopolitical uncertainty will again pave the way for strong investment demand.
So you're saying that the best of the silver demand really will come in from the industrial applications this year around, Michael?
We do. We think it's going to be strong, even though we see signs of a slower economy across the world, or at least in various regions. Our consultants at Metals Focus feel that that the industrial demand will achieve another record year.
All right. Michael, how are you looking at the prices to begin with? Because it has been a slightly disappointing year. We haven't been able to hold above $20 per ounce as much as silver or silver bulls tried.
Yeah, we remain very, very cautious about the silver prices here with respect to giving forecasts. Even though inflation has shown some signs of peaking, it has remained elevated and is still significantly higher than the Fed's 2% long-term target. So with that in mind, we're looking at about a bandwidth of about 2160 to 2210 for 2022.
All right. Michael, also, when you talk about India and the kind of demand that we're seeing here really seems to be picking up. I mean, industry has been telling me that 500 to 700 tons per month of silver import is what India is looking at right now. When you look at India and the kind of incremental demand growth that we continue to see here, what is your sense on what numbers could we be looking at for this year or the next?
Well, I don't have insight into the exact numbers, but one thing about India is this. India is so important to the overall silver market on the industrial side, on the jewelry side, and so forth. But it's really becoming very important to the investment side. And later on this year, we'll be putting out a report which examines silver investment in all aspects in India. And I'll be happy to share that with you, Manisha, when it comes out.
We will wait for that, Michael. Also, what's your sense on the global production and consumption numbers right now? I mean, we all understand that this is going to be yet another year that silver could be headed for a deficit.
We do believe there will be a deficit this year. We believe it will be higher than the 51.6 million ounces that we saw or 51.8 in 2021. 71.5 is what we're saying right now, but that could even be higher. Even though we're forecasting more supply of silver to the market, both from industrial scrap, but also from an increase in mine production, we believe that the deficit will be higher in 2022 than it was in 2021.
And is that the trend that you expect seeing in the coming years as well?
We do indeed, Manisha. We absolutely.
Michael, another thing, and we do understand that even as gold has been very volatile, silver tends to be even more volatile than that. What is the cost of production that you're looking at for silver right now?
In terms of the cost of production, you said?
That's right.
Well, we think that the cost of production with respect to on the mining side will be lower than it was last year. But the volatility, you raise an interesting point. It has shown exceptionally high volatility this year, silver. You know, we had a high of 26.94 and a low of 18.15 in July, and that's a $9 bandwidth. And we think that with silver being viewed as both a precious and an industrial metal, the combination of rising interest rate hikes and rising treasury yields and recession fears mean that silver has been particularly vulnerable to the professional investors' sell-off, and not so much on the retail investor side.
Fair point. When we talk about investments itself, Michael, where do you see that getting in most from? I mean, is it the physical part of it aspect or the ETF buying? What way are people really acquiring silver?
Well, it's a combination of both, but I can tell you quite frankly that the demand for the investment in bars and coins and so forth is really outstanding this year. You talk to any coin dealer or any of the 13 authorized purchasers at the U.S. Mint that sell these American Eagles to consumers, it's off the charts. And as a result, the premiums are high, but consumers and investors are still paying for these bars and coins. It won't be a record year, but it'll be a very, very strong year in terms of overall demand. Our biggest challenge is producing enough coins at the U.S. Mint, the blanks. They're running 24/7 to try to get these American Eagles and other coins to the investor.
Also, Michael, when you look at geographical, distribution and sense of demand, of course, India is one of the bigger markets there. But what has been the growth when you look at silver buying across map?
Well, you look at the United States, you look at China, you look at parts of Europe and so forth. But India really is the story today. They are coming in droves, and then not only are they looking at the physical, you've got new exchange-traded products on the market in India. So that's a country that we're really keeping an eye on. And like I said, well, I'm really looking forward to seeing our report later on this year.
Michael, another thing about silver clearly is the gold and silver ratio. And a lot of people, a lot of investors do really take a look at that as well. How relevant or how often do you do that?
I don't look at it that often. I'll be quite honest with you. I mean, there are certain investors who really pay a high premium on that figure. I don't look at it that much. It is important to some. It's not that important to others. But it's an interesting anecdote. I mean, there's a gold copper, there's a silver copper, there's the gold silver ratio. So there's many ratios out there. We were closing the gap earlier this year, and I think that bandwidth is growing even as we speak. So we hope we can reduce the ratio of silver to gold later this year.
Michael, also there's a big market when it comes to silver scrap as well, and also when it comes to silver hedging. How have those two numbers been to you?
Not so much on silver hedging, but on silver scrap, it's interesting. When the price gets higher, silver scrap is pretty much led by gold. If gold price is increasing at a certain point, people tend to scrap all their jewelry, all their metal at once. On the industrial side, we're going to see more scrap from EO, ethylene oxide, this year. So we're forecasting a slight increase in industrial scrap in 2022.
One final question then, Michael. What's your sense on prices? I mean, you've given me a range for this year then, and would you say we've seen the highs in this year already? And how are you looking at it, let's say, next 6 months, 12 months trajectory for silver prices then?
Well, we always have to remember, I should say, that silver is both an industrial and a precious metal. So on the industrial side, we're seeing strong demand. The price of silver has somewhat befuddled me this year because the fundamentals of the metal are good. The miners are doing well. It's just not reacting like it used to with respect to inflation and recession fears. But I think that's going to turn around. I do believe that our outlook on silver, 23.90 maybe a little bit high, but quite frankly, it's going to be a good year. And we think 2023 and beyond is going to be even stronger for silver.
All right. And Michael, how much of the strength in US dollar do you think is weighing onto the commodity markets right now, including silver?
We think it's having a huge impact.
And,
Absolutely.
And ahead of the September interest rate meet, do you think yet another dent coming in for this sector?
That's an interesting question. I can't go that far into the future, but I do believe that once we get through this and once the inflation concerns are mitigated, we expect silver to boom further in 2022 and clearly into the future.
Point taken. Michael, thank you as always for joining us. Well, that's a view coming in from the Silver Institute. The silver industrial demand is expected to hit a record highs yet again in 2022. As far as the prices go, well, that seems to be in a construed band right now between 21.6 to 22.10. Of course, once we break this one, then is when we will see further gains. Michael, thank you so much for joining us. And that's all the time that we have on Commodity Champions. Thank you for watching.